Choppy trade continues on D Street with the Nifty near the 25,300 mark and mixed moves in the broader indices as the small cap index outperforms. Metals are the biggest laggards today as the index snaps a 3-day gaining streak amid cool off in commodity prices and profit booking. ITC saw steady growth, but profit came under pressure on a higher base and margin normalization. Davos quarter reflected muted urban demand, with rural recovery still gradual. Swiggy's results highlight continued scale up in quick commerce and food delivery, but losses widen. Tata Motors CV saw strong profit growth even as revenue came in below estimates. Management remains optimistic on FY27, citing strong momentum in trucks, buses, small commercial vehicles and exports. Paytm delivered a strong Q3 with higher revenues, expanding EBITDA margins and a return to profitability. Dixon Tech was in line, but smartphone demand stayed weak. Cinema SGS posted an across-the-board beat with strong revenue and profit growth. All right, hello and welcome. You're watching Closing Trades here on Nifty Now. I'm Harsh Saita. Very quickly, let's have a look at Nestle's numbers. Let's pull up those numbers for you. The stock price seeing a bit of a spike. Mixed set of numbers is what is playing out with regard to where Nestle is concerned. I'm going to quickly pull out the numbers for you. It'll come on your screen in just a minute. But essentially, what it seems like is that while the top line seems to be largely in line, it's a margin miss as per what Bloomberg consensus estimates seem to suggest. While we're at it, you can see that the EBITDA number has come in at 1,202 crore. The expected number with regard to EBITDA was expected around the 1,185 crore number. So just a marginal uptake versus what estimates seem to be indicating. The top line was expected at 5,600 odd crore. That number has, or 5,200, I beg your pardon, 5,200 odd crore is what the expectation was. Profit beat, revenue beat, margins is a miss. So it's a mixed set or a mixed bag in terms of those numbers. Let's pull up the revenue number if we can for just a minute very quickly on Nestle. So 5,200 was the estimate. It's come in at 5,700. So a very strong beat. But essentially, the 1185 crore number of EBITDA, that was the estimate. The actual number has come in at 1201 crore. So the margin compression is obviously very, very strong versus what was getting penciled in by the street. So that is one thing to keep in mind. Let's also pull up that profit number with regard to Nestle. There's a 10 crore, of course, impact of labor code that has been uniform across the board. Profit at 1,018 crore. That too is a strong surge versus the 730 crore number that was penciled in. Snehi here with a roundup of those numbers. Snehi, how are you reading these numbers?
Oh, well, it's largely a good set of numbers coming in from Nestle, and we were expecting also a good quarter from Nestle this time around. The revenue is a beat. EBITDA is in line with our estimates, bang on over there. The net profit is a beat. Now, remember, there is an exceptional gain of about 156 crore rupees, but even if you negate that, despite that, the PAT is a beat. So, very strong growth over here. Margins are slightly under pressure. Raw material inflation has been highlighted. We'll get to that in a bit, but yes, margins are a beat versus what we were estimating. Other than that, if you take a look at what the company is saying, they've logged in their strongest volume growth in nearly 5 years. On Nestle does not specifically reveal its volume numbers. These are implied numbers, but yes, the press release says that it's the strongest growth in 5 years. All 4 product groups have delivered positive volume-led growth, with 3 out of 4 products and their groups witnessing robust double-digit growth. So segmentally also very good performance. Confectionery was the fastest growing segment, saw double-digit growth. Kit Kat, Munch have done well. Powder and liquid beverages have seen robust growth. Prepared dishes and cooking aids have also seen double-digit value growth. Maggi noodles has delivered delivered double-digit volume growth. So once again, a very stellar show coming in from the Maggi segment too. Milk products and nutrition product groups showed improved performance with mid-single-digit growth. So improvement here. This has been a pain point, milk and nutrition for Nestle, but there has been marked improvement here, and Milkmaid has continued to do well. The pet food business has reported strong double-digit growth too. Nespresso is continuing to grow. Out-of-home business has delivered double-digit growth, and general trade too, a double-digit growth in that channel as well. In terms of raw material prices, the management has said that milk prices are not coming down despite having a flush season. Edible oil remains elevated, and it's expected to trade sideways in the first half of 2026. Coffee prices, however, have stabilized. So that's the roundup on Nestle. Overall, good set of numbers coming in. The PAT and the revenue are a beat, EBITDA in line, and EBITDA margins slightly below what the street was estimating.
Okay. Volume led, very likely. Thank you so much for that, Snehi. Kaustubh Pavaskar also joining us, lead analyst at ICICI Direct. Kaustubh, how are you reading into the numbers? First off, right off the bat.
So yeah, strong set of performance. In fact, 18.5% revenue growth was way ahead of what we and Street were anticipating for the quarter. We were penciling somewhere around 11% kind of a revenue growth. It was anticipating around 13% kind of a growth, but 18% growth was much better than what we and Speed were anticipating. And the company has already indicated that large part of this growth is been driven by the volume growth, substantial volume growth. So on revenue front, it has been strong. However, at the margin front, the margins at around 21% came lower than what we were anticipating at around 22%. So I think the inflation impact is still there, raw material inflation, and we need to monitor in terms of how the raw material prices momentum would be in the coming years. But definitely on the revenue front, it is one of the strongest quarter for Nestle after they have already seen improvement for past couple of quarters in terms of growth. But Q3 the growth was much better compared to what it was in the first half.
Would you be worried? Volumes seem to be very strong, but at the cost of margins, would you be worried?
I think once the commodity prices, stabilize, I think even margins would recover. I think that should not be a worry until the time you are posting, solid volume growth numbers. In fact, even this 18% growth, we need to understand, how the impact of stocking or inventory pile up post the GST implementation. That is also something which we need to be monitored. Going ahead, what could be the volume growth momentum would be for the company in the quarters ahead. But in this quarter, it was one of the strongest quarter in terms of revenue performance for Nestle.
Okay. What is your sense, Kaustubh? Is this kind of sustainable going forward? Obviously, we'll have to hear from management. But what you track the sector closely, rural seems to be doing okay, it seems, but urban still hasn't picked up significantly. What do you sense is the lever for this growth, and how sustainable is it, volume-wise?
So obviously, one of the important lever is the GST rate cut. So if you look into the performance of some of the other FMCG companies, we have already seen there is a recovery in the revenue growth. For example, yesterday ITC came out with the numbers there. FMCG business also seen a good recovery, got back into the double-digit revenue growth trajectory. Some of the other companies are also doing good in terms of revenue growth. So categories where the benefit of GST rate cut was there, I think those categories have started seeing a good growth. Obviously, rural demand is also picking up. Urban demand is yet to see that kind of revival or much push in the and that is something which will be monitored ahead. But if we see, demand in the urban market recovering, I think that will again act as a lever for FMCG companies in the quarters ahead. So I think, for the sector as a whole, I think the growth will improve unless there is, something like inflationary impact or, slowdown kind of a situation is there. But I think the GST rate cut, whatever initiatives the government has undertaken, I think that should help this growth momentum to further improve in the quarters ahead.
And Kaustubh, sorry, last question. I know I'm keeping you waiting. What was your volume estimate? What were you penciling in versus what do you think likely the volume number has come in at, in your opinion?
We were expecting around 11% volume growth, and I think volume growth definitely would have been much better than what we are anticipating considering the growth. But whether there is any price mix impact considering the category mix improvement as well, that is also need to be understood. But
Sorry, so
obviously we believe that volume growth should be much better than what we were anticipating for the quarter, what we and Street were anticipating for the quarter.
sure. And were your estimates ahead of the Street? Because my understanding is the Street was penciling in something around 7. Am I right?
Yeah. So we were anticipating around 700 crores of PAT for the quarter, and PAT came around 1,000 crores, so ahead of what we were anticipating. In fact, Street was anticipating around 750 to 770 crores kind of a PAT. I think it came better than a Street expectation as well.
Apologies. In terms of volume growths, you were penciling in 11, right? I just want to kind of clarify this for viewers.
Yeah.
You were penciling in 11%. Street seems to be penciling in around 7. Was that what the consensus was in around? So you were in any case on the higher end of that consensus, right?
I don't know much about the Street, but
sure.
I guess it was more in terms of 9 to 11%.
Fair. Okay, point taken. And how much would that beat be is currently difficult to quantify.
Yeah.
Okay. Kaustubh, thank you so much. I know that, in the thick of things, it can get tough to kind of give answers right off the bat as soon as numbers come, but you've done a damn good job of it. So thank you for that. Kunal also joining us in the studio, Kunal Bothra, as always. Kunal, on Nestle, how is the chart looking?
Yeah, I think, so far the stock is doing very well for itself.
Yes.
It's up, I think, around 3.5%. And I think specifically at a point where the stock was due for a breakout of sorts on the daily charts. The last few, weeks, couple of weeks at least, the stock was building onto a consolidation at a higher range. 1280, 1320 approximately was the 40-point range for Nestle. So it's a good sign that the stock finally showing signs of a breakout above this 1320 resistance. We'll wait for closing. I think if the closing is also above the 1320 levels, we would probably expect that this could be a breakout candidate for the entire FMCG pack.
Kunal, going to tie 2 questions into one. Your call on the Nifty and how it's playing out in trade today, and your top picks for this afternoon.
So I think it's an excellent recovery for the markets, specifically from the fact that we've recovered almost 130, 150 plus points from the intraday lows. So I think in that sense, it's a good recovery for the index, and that's trickled to many of the larger cap names which have started to show signs of recovery. Reliance, I think, has been doing fairly well for itself, and the market breadth, of course, has been a little disappointing because of the kind of sell-off which you've seen for few sectors like metals, etc. My expectation is that going into the budget, if the markets come back towards 25,400, 450 kind of a mark on the spot levels, that would probably mean that the markets are going with a slightly optimistic, I'm not saying optimistic, but slightly positive note, at least looking at the last maybe 1 week of sell-off. In terms of the trades, I would look at 2 buy calls. The first one is about Bajaj Auto. That's a chart which is heading towards a breakout. We were discussing this a couple of days back also, that it seems to be one of the favored names from the two-wheeler pack, specifically on the short-term charts, heading towards a flag pattern breakout. So we look out for 9,800 as a target. Stop loss could be kept at 9,500. And the second would be about ICICI AMC, limited chart history. But then I think on the daily charts, the stock has come back towards a breakout or very close towards a breakout of its previous swing highs. So we look out for 3,100 as a target. Stop loss could be kept at 2,940.
Okay. So that's the take with regard to some of those counters. What we'll do is slip into a very short break. We'll continue coverage. In fact, Bajaj Auto also expected to declare numbers. I'll give you a snapshot of what to expect as well from Bajaj Auto. Stay with us. Welcome back, and we're joined by Rakesh Vyas, CIO and Portfolio Manager at Quest Investment Managers this afternoon to try and get a sense of how he's viewing markets. Rakesh, let me first try and set the context. Obviously, there's just so much uncertainty we faced over the last 12 months or so. How do you see maybe the next 12 months in terms of how Indian markets will perform? Because we've sharply underperformed the rest of the world to a large extent. And mid caps and small caps have especially seen a lot of pain. So portfolios are in pain. When does that reverse? I'm trying to get a sense.
Having me on this show. You
Great
are
having
right.
you.
I mean, look at it, last 15 months actually has been far more challenging than what we have seen in last 4 5 years. But I think a large part of it is also to be blamed upon the very moderate kind of earnings growth that we saw in the market. And as valuations were reasonably fair to expensive in that context, and deceleration in the earnings growth is what led to the massive underperformance that you see compared to the other global indices. But as I see from here on, I mean, lot of the impetus being given by both the RBI and central government is trying to boost the consumption, and that's what seems to be picking up now. So if you look at even the credit growth data that RBI releases fortnightly, the last release does indicate that we are seeing almost close to 14% credit growth, which does suggest that the consumption seems to be coming back on track. And in that context, I think if you look at over next 4 to 5 quarters, there is very strong chance that the corporate earnings will revive back to its normalized numbers between 12 to 14%. And that being the case, then market return should also follow that trend. If you see now for all the results that have come so far for this quarter, we seems to be broadly in line with what the expectations normally were, adjusting for some of one-off related to labor code, etc. Which means that a large downgrade cycle that was continuing for last 5 6 quarters seems to have halted. And therefore, that gives us a confidence that as you move now incrementally into next 4 quarters or so, the earning revival should be reasonably strong. So we remain fairly more constructive on markets going into calendar year 26 already.
Okay. Rakesh, where within the mid cap, small cap versus large cap are you spotting opportunities? At least between these two cohorts, would mid cap, small cap be the preference?
Yeah, I think if you look at from next 4 to 6 quarters perspective, I still think a lot of opportunities starting to emerge in mid and small cap names. Some of the small caps are also impacted largely because earnings have been disappointing for them compared to what the expectations were. But as we move now going forward on a reasonably more muted expectations, there is very strong likelihood that we'll see reasonable outperformance in earnings from small and mid cap. And that's an area of pocket where we should start to look more deeper into. However, I'll just caution as well that I don't expect there should be any massive re-rating of this space because multiples are already fairly reasonable. Therefore, the overall expectation of return should be commensurate with the earnings that we see from that space.
Okay. And Rakesh, so therefore, where's the tilt with regard to sectors? There are clearly opportunities that you're seeing. Where are those opportunities most obvious in terms of maybe your top three, maybe sectors, sub-sectors, which are looking really good?
Yeah, great question, Harsh. I think if you look at our portfolio positioning today, I think we are fairly more tilted towards BFSI as a space, of which I think incrementally we have started to take reasonably meaningful position in the small and mid-cap private bank space or NBFCs in general. And I think the capital market as a play continues to remain fairly strong, given that last 12 15 months have been far more challenging in terms of market return. Even then, we continue to see very strong inflows coming in for mutual funds. And I think as we start to expect a normalized kind of return profile from here on, the MTM gain and the continued inflows will continue to support capital marketplace. So within BFSI, I think these two are places where we are fairly more positive. I think over last 4 to 6 quarters, we have also been fairly positive on the consumer discretionary space. That's one of the bet that we have, especially given, as I highlighted, the RBI and central government interventions that happened with a focus on reviving consumption, and most probably consumer discretionary as a space will continue to do well. So our bets are there off in that space as well, with some of the platform companies also taking large share of our portfolio construct. So we remain fairly positive on autos, hospitality, real estate, and platform companies that I highlighted. And the last thing that I would probably talk about is also the power T&D space, because that's a space where we believe that not just in India but globally there is going to be a massive investment that will come through over next 4 to 5 years, and there are various plays both within the EPC construct as well as the equipment supplier where we have reasonably good position on. So these are the three larger themes that I will probably highlight too. And last one where we are more, uh, I would probably say selective, but starting to become far more benign about is basically the manufacturing space. Because I think as the demand continues to improve, the utilization levels of most industries will increase thereof, which has been a trend that was missing for last 3 4 years. And in that context, then you will probably see private capex coming through. At least the announcement will start in next 12 months or so.
Hmm. Okay. Uh, where within power would you play? So, where within the energy value chain uh, are you most positive, if I can ask you? Because there are just so many ways of playing the theme. One of them is obviously your power lenders. REC came out with numbers yesterday. Very unenthusing set, to be honest, in terms of growth. Didn't come through, and I think the street is disappointed on the back of that. But some of the T&D numbers have been extremely strong. TD Power, GET&D. But again, cash flows there in that space sometimes becomes a concern. How should one play it?
So our exposure largely is more towards the transmission space, if I could classify it like that, both in terms of the equipment suppliers, especially around the HVDC and the high voltage transmission equipment suppliers, as well as some of the EPC players who will probably continue to play a major role in strengthening the grid largely. And I think our exposures to companies like Kalpataru and Techno Electric, Hitachi Energy has been towards that. And we continue to remain far more positive in that space because I think as the renewable continues to gain traction, we will need strengthen in the grid system. And that's a phenomena that not just exists in India but globally as well.
Okay. Uh, Rakesh, just last take with regard to looking outward. Uh, Europe is emerging as a very, very interesting opportunity, especially for some of the textile players. Some of them are also beaten down, those who have more exposure to manufacturing out of India. And then you have India US, which is still in the pipeline, still in the works. What opportunities could both of those really unwind? And IT as well. Give us a sense of all export related sectors, spaces that look good to you.
You are right. I mean, Europe FTA is probably a very strong tailwind that will come through to many sectors, including the ones that you highlighted around textiles. But I will also nuance with the fact that the benefit of it will actually take some time for it to start accruing because there is still a lot of supply chain approval process that goes through, and then companies will also have to do meaningful capex to gain traction around that. But we also have to be kept in mind the US India trade deal because if that continues to get delayed, then there is still incremental capacity that is available with the textile manufacturers to move from US shipments to Europe. But largely, I think if we have a deal with US pretty soon, then a lot of export-oriented sectors will actually see a meaningful run-up because incrementally there seems to be more pressure on margins as well as sales velocity for those sectors. Coming to IT, I think that is one space where we have been slightly unconstructive on for last almost 18 months or so. And I think valuations have also corrected meaningfully now. It has come to a level where at least the free cash flow and the dividend yields now provide reasonable support. But I would start to become more constructive on names where there is still strong visibility of growth and the valuation that you are paying is still reasonable and not very expensive. As I said, in many cases, valuations have corrected as well. But in the larger IT space, so to say, I think the corporate earning growth will probably lag the market earnings, and therefore I might be slightly more cautious there, but we'll continue to look at opportunities in the mid and small IT space.
Okay, interesting. Rakesh, thank you so much for coming in and speaking with us. This has been a good one.
Thank you so much.
Right. Viewers, what we'll do is again dip into a very short break, mandatory one. We'll come back, we'll continue conversations on the other side of this very short break. Well, it's time for budget conversations. Again, as we always do, daily, we get you a partner from Deloitte, and today it's Munjal Kamdar, who is the partner with regard to cyber security at Deloitte. Munjal, a very interesting niche, right? Just let's set the context before I get into a little more granularity. How is India placed versus the rest of the world when it comes to cyber security? How well placed are we? We've got huge digital public infrastructure. Are there big gaps there?
So, thanks for the question. And you're right, cyber in India is a big concern, given the fact that we're just a country, the most populous country in the world, right? 1.4 billion people and a whole lot of digital data, world leaders when it comes to digital payments, right? I mean, we do more transactions every day than China does. So there's just no comparison, right, to what India has progressed on the digital front. And that makes cyber definitely a concern for a country like India. So, well, in terms of placement, we can talk through figures in, who spends how much. But yes, there is a lot to be done as far as India is concerned and improving our cyber security posture, given the budget that's coming up in a day.
Okay. And what are the kinds of gaps that we're currently seeing in terms of cybersecurity in India, and what can the budget in specific try to repair, in your opinion?
So, see, I'll tell you in terms of why is cyber important to India. So, if you take a top-down approach, the first part really is, as I said, just the population, right? The highest number of online users anywhere in the world, the largest app market in the world. So there's just something that, and given the semi-literate nature of India's population, there is a certain amount of vulnerability that comes with that. So that's point number one. The second is, last year, India exported about $250 billion worth of software and IT-enabled services, right? We are the back office to the entire world. So if anything that happens in India that impacts its cybersecurity posture, it can practically impact India's position as the back office of the entire globe, right? So that's the second part. And the third is around data sovereignty, right? So given the fact that AI is developing, we have so much of digital public infrastructure, payments, all of that put together. That itself makes data sovereignty very important. India wants to be able to control its data. India wants to be able to give its citizens a secure environment to operate. So these are aspects that makes cyber critical for India. Now let's look at it from other aspect as well. India is unique geopolitically, right? Most, if not all, our neighboring countries have some amount of unrest, right? And I mean, be it Pakistan, be it China, be it Myanmar, be it Bangladesh, be it Sri Lanka. So there's a constant threat from that aspect as well. I think geopolitically, we would be most closely comparable to Israel, a country like Israel, which again has the same situation. And by the way, Israel is one of the largest cybersecurity hubs in the entire globe, and that's the reason why it's like that, right? Because of the sheer threats that they face, and that is something that India needs to cultivate as well. If you look at just figures, right? I was, looking up some figures. Indians have lost about 53,000 crores in the last 6 years on cyber frauds. 90% of that money is never recovered, right? Out of that, about 20,000 crores was just lost in the last 1 year. So there is an omnipresent financial danger as well to Indians who may not be using securely the internet as well as its applications. And also, if you look at cyber attacks, there were about 22 lakh cyber attacks recorded in the last 1 year itself. That's doubled or more than doubled from about 2 years back. So that's the landscape that I would say exists in India as far as cyber is concerned. And that's where the budget will need to play a role as well.
Couldn't we build something more centralized, and how large is the case, or is having a more fragmented approach the better way to tackle this problem in your opinion?
See, we need to do a couple of things. I think it has to be a combination the way our government is, right? We have a federal government and we have state government. So there are certain activities that need to be done centrally and that is more effective. And certain activities need to be delegated now. Now, if I just look at numbers, right? See, India has a defense budget that's about $80 billion annually, right? UK has a defense budget that's $60 billion. But if you compare the cybersecurity spending, India last year, the 2025 budget, 1,900 crores was allotted to cybersecurity, which is roughly about $215 million, right? If you compare that with UK spent more than $3 billion on cyber, even though the defense budget was lower. Now, I'm not saying that India's defense budget needs to reduce, rather that the cyber allocation needs to increase. See, India has a cybersecurity policy that was drafted way back in 2013, about 13 years back, by the Ministry of Electronics and IT. It was followed by the cybersecurity strategy, which was formalized by DSCI in 2020. What needs to be done is fairly well articulated in those policies. I think it's a good policy. There's a good strategy. At least what has to be done has been identified clearly. Now the initiatives need to be carried forward. And that's where we look for budgetary support. So if you look at aspects that has already been recorded, right, it's been things like public-private sector partnership, PPP models, right? Centralized infrastructure to monitor threats to the energy infrastructure, financial infrastructure. So those activities have been identified clearly. I think now is the time for the government to start executing on those aspects with adequate financial and budgetary support.
Okay, and so you're proposing not a comprehensive overhaul, use the 2013 framework to build on. Is that what you're proposing?
Right, absolutely. So so for example, if you look at the 2013 National Cybersecurity Policy, right, it covers aspects of protection of critical infrastructure, institutional mechanisms, as I mentioned, public-private partnerships, capacity building. The objective was to train 500,000 professionals in cybersecurity, right, defining compliance standards for India, as well as establishing a legal framework. Now, in the recent past, a lot of these activities have been done. So, for example, as you're aware, we have the DPDPA Act that got passed. The rules were notified in November 2025, right? So that's already been done. And if you look at the cybersecurity strategy, that basically looks at three pillars, right? Securing, strengthening, and synergizing. So all those aspects are there. Now, if you ask me, if you look at the whole gamut of the cybersecurity challenge that India faces, right? I compare it to, if I just draw a metaphor, it's like, a 10-story building is on fire. But if you reach there with one bucket of water, it's not going to help. Right. So the aspect really needs to be that we know what has to be done. Now we need to get that going. Right. We need state-of-the-art infrastructure. We need more participation with government to encourage Indian startups, right, to focus on cybersecurity. We need active collaboration even with players who may be abroad, be it Israeli firms, be it Western firms, wherever they are, because we need to learn those technologies as well. And finally, we need to strengthen our aspect on training, right? We operate in the cyber industry. I've been part of this industry for more than 25 years. And I can tell you one challenge we always face is shortage of talent, right? We have a few institutions, educational institutions that train our students on cybersecurity. That's a good start, but it's not adequate, right? We need something much more than that. And those are the aspects that we need to focus on. And that's what I'm hoping that this budget will resolve and will allot, right? We need to go way beyond the 1,900 crores that was allotted last year. It was a increase over the previous year. I think it was about one third, 768 crores in the earlier budget. So, but a threefold jump is still not adequate. We need to do much more than that, and we need to get those aspects going with the Indian public sector organizations participating, actively collaborating with the private sector startups and organizations as well.
The UK, you alluded, Mr. Kamdar, and for me also it was new. The UK allocates approximately 5% of their defense budget to cyber, right? $3 billion out of the $60 billion budget. How much does India need to allocate?
So, in my view, of course, we have a very large defense budget, given again the geopolitics that we face, right? But to me, it should be in the same region of what the UK does, right? So, if you have a $80 billion budget, and that was 6.8 lakh crores last year, we would look, I think, 5% allocation is along the same lines. In a country like India, we will need those funds. Frankly speaking, of course, I don't know where those funds will come from, right? So that's a challenge for the government as well, because that would be an amount that's close to $4 billion from the $215 million last year. So almost a 20 times jump. I don't know whether that would be feasible, but at least that's a direction we should look at, right? A country like China or US spends far more, I mean, many times more, but we need to get there over a period of time.
Right. Thank you so much for coming in and speaking to us. This has been a pleasure. That's, of course, on that very, very niche topic with regard to cybersecurity. What we'll do is slip into a very short break. We'll start, or rather continue, market conversations on the other side of that break. Stay with us. Welcome back. Time to talk numbers, and time to talk to one of the managements of corporate India. Very, very strong numbers. We have Parvat Srinivas Reddy, who's the managing director at MTAR Tech, joining us. Mr. Reddy, always great speaking with you. You stand at the confluence of, and this is for viewer perspective, stand at the confluence of aero as well as nuclear. And that's what makes MTAR Tech so very, very interesting. But let me take a step back. Let's talk about Q3, sir, first off. Let me try and understand from you what led to the kind of beat that you've delivered in terms of the Q3 numbers. Because not only have we seen record in terms of top line execution, so that's been very strong, but you've seen a surge in margins at 23%. We've not seen those margins before from you. So talk to us about, I know that there's a bit of products mix shift that's happened. Talk to us about what has played out and what is likely to play out in Q4.
So basically, we have done extremely well in our clean energy segment because of the demand that has been created. Obviously, we had to ramp up to that level, which we did very successfully. The execution was very good, and it will continue to improve further quarter-on-quarter basis. And also, we have been working on a number of growth engines in aerospace and other divisions, nuclear, over the years. So the other growth engines are also showing pretty good results right now. And because of the operating leverage and higher revenue numbers, we're able to even achieve the margins that we would like to achieve, and even further improve moving forward to the next quarter as well.
Mr. Reddy, you've guided for 900 crore top line in FY26. Very likely, because you're currently at 280 in terms of execution. You've done 280 crore this quarter in Q3. It'll mean that you have to do at least another 350 in the next quarter. Likely to happen?
Yeah, absolutely. I mean, we are going to do obviously more than 300 crores, obviously, to achieve the 900 crores plus. That's right, definitely on the track, and we'll be able to do that.
And what next year? You've guided for another 50% growth next year. Obviously, your order book is extremely robust. So what changes for you all of a sudden? Because you seem to have hit a different pedal starting H2 FY26. What has changed?
The three main areas, I mean, I would say the clean energy segment is one area.
Yes.
The aerospace is showing very good results, going to be a very good growth engine for next year as well, in a much bigger way. And then the nuclear is going to take off next year very well. The kind of orders we have received from that division as well. And we're also entering into new segments like oil and gas next year, the second half of the year. So the guidance what we have given is 50% revenue growth rate is on. It's a very reasonable guidance to begin with, and that's something which we'll be able to achieve, and also with improved margins as well.
Exactly. That brings me to the margin picture, right? You've guided for 21% margins in FY26, but you had one muted quarter, which is Q2. In terms of your margin number, that was mid-teens, 13% odd in terms of margins. Talk to us about what FY27 will look like, because if top line grows by 50%, which is from 900 you go to 1350-ish, your margins, your operating efficiency should kick in. But outside of that, you're saying that product mix shift is also aiding in the numbers. So what's the kind of steady state margin you're targeting, and what is the FY27 margin we can expect?
So we are expecting, I can't really come to the exact numbers right now, but we are showing we are going to get a very high number, much better margins. Like right now, we're doing 23 for Q3. Obviously, the Q4 margins will be slightly better to average around 21 for this year. So next year, something between 24 to 26%, we might even go up to 26%. We just have to see that. But definitely much, much improved margins for next year.
Is that something that can continue going forward in terms of the 25-26% margin number? Is that sustainable?
Yeah, it is sustainable, and we might do even better moving forward. As and when we go to FY28, it will be even better. Based on the kind of order book and the demand what we're looking at right now, it could even be better the subsequent years.
So in terms of product, Mr. Reddy, explain to us which of the products do better margins, and therefore I'm trying to sense, because you have a tilt now towards aero and nuclear, are the margins materially better versus the 20% that you've traditionally done?
Yes, definitely, because we have been investing a lot in the first articles, various other developmental activities. What numbers you see, you don't see the actual work being done by the company over the last couple of years. And now you're seeing those numbers kicking in, because we have been working on a lot of R&D, developing a lot of products, parts, first articles over the last couple of years. So obviously the margins would be substantial in aerospace and nuclear as well. And that would improve the margins further. The revenues are going to improve in these areas much more. That will aid to the margin improvement. And because of the huge operating leverage in clean energy, it will obviously help us to achieve higher EBITDA margins. So what we're looking at, what I said is about 26 to 24, 26% can be, that's on the conservative side as well. But we'll comfortably be there in the next financial year.
Mr. Reddy, if one were to take FY27 as the base, where do you go from there in terms of growth? Because obviously now the base will have shifted in a dramatic fashion. You would have gone from 500 to 900 to 1350, right? Can you continue to grow at that clip? Is that the kind of traction you see? Because aero and nuclear is just about 13% of top line. So there is scope, but I'm trying to understand how you see it.
It's very clear the kind of roadmap we have. At least I don't want to talk about many years, but even if you look at the next 3 years, for example, we would be able to grow at the rate of 50% revenue growth for the next 3 years. I don't want to comment beyond fourth year, fifth year and all. Things might be even better, but this is the kind of consistent growth we can see year-on-year basis.
You do that, so you go from 1350 to 2000 to 3000 crore in terms of top line. What is the mix? How does the revenue shape up? New energy versus...
It's going to be, the revenue mix would be, the clean energy would be about 50 to 60%. Okay. 50% plus. And then we would have the nuclear division and the aerospace kicking in a lot of percentages there. So defense would be another area which we are looking at more and more. So it's a combination of all the... See, we are into multiple segments. That's the advantage in which we are in. It's just not in one area. So we are building in oil and gas as well, which will also kick in in year 2 and year 3 as well. So that's how we have built a clear plan over the next 3 years, how we need to grow based on the kind of forecast and order book we have and the kind of feedback also what we have from the customers as well.
And capex, what's the plan with regard to that? Because venturing into so many different arenas, is the capex completely done? Will you scale up gradually? How does that play out?
We would scale up gradually, like we have the capex in place, but there are certain expansion plans for clean energy as well. Oil and gas, we're doing the expansion plans. So these will be in place over the next 1-2 years. So we are building our capacities based on the demand. So right now the situation is more on the clean energy side. It's more on our execution and the capacity levels what we have rather than the demand is a lot more. That's all I can say right now. So we're trying to catch up on that, ramp up our capabilities to achieve as much as possible over the next 3 years.
And would you say that a demand comes from government for you? What's the predominant customer cohort?
Mainly the nuclear is basically from the NPCL government
Yes.
orders, nuclear reactors, what we have. Obviously, the aerospace is all MNC customers that we are working with all over the world. So that's something which is very encouraging for us. We have done a lot of work on that. A lot of certifications have been done towards that. So that's where you'll be able to see much larger numbers moving forward because of the kind of work we have done in the past.
Mr. Reddy, thank you so much for coming in and speaking with us. And of course, it's a cracking Make in India story which is playing out right in front of us. Of course, viewers, that's a very solid set of numbers. But the stock of MTAR Tech trades at over 100 times earnings. So that's something also that you want to keep on your radar. But very, very strong commentary coming through. 50% growth for the next 3 years in terms of growth CAGR. Takes the top line to 3,000 crore. But when you're looking at the market cap, it's sitting at 9,000 crore at this point. So something to of course, keep in mind. But what we'll do is slip into another very short break. We'll continue conversation this time around with regard to all of the stocks which are moving in trade. Let's talk about those on the other side of this break. Stay with us.
South Indian Bank slumps by 15% after its MD and CEO says he's not looking for a reappointment. This is the biggest single-day fall ever for the stock. Nestle India reported strongest volume growth in over 5 years, with all business channels seeing double-digit growth. Now all eyes on Bajaj Auto, where it is set for a strong third quarter, driven by export-led volume growth, favorable currency moves and higher average selling prices. In an exclusive conversation with ET Now, CEA Ananta Nageswaran says India's growth has accelerated on structural reforms, with momentum expected to sustain into FY27. Industry bodies FICCI and CII expect 7 to 8% GDP growth next year, back with a credible fiscal deficit path, and are pushing for a stronger thrust on manufacturing, capex, exports, and ease of doing business. Trump has launched a fresh attack on Fed Chair Jerome Powell, slamming him for refusing to cut interest rates. Trump said high rates are hurting the US economy and even national security, arguing that inflation is no longer a threat and borrowing costs should be much lower. Back with closing trades and lots to talk about on the show, but time now for an ET Now exclusive. We have learned from our sources that the government is well to announce the next phase of the ISM scheme, and Sumita Karir is joining us with more details on that.
That's right. We're given to understand from government sources that the India Semiconductor Mission Phase 2 of the scheme is going to be announced, or likely will be announced by March end or April, and it's going to have additional features. We're also learning from government sources that as far as ISM 1.0 is concerned, there is still space for approvals for 2-3 more projects, and these approvals will be completed. These will come in by February, by the end of February. In fact, as far as the incentive for ISM 2.0 is concerned, that incentive could be trimmed a little bit, because the government's focus, or the government's intent with ISM 1.0 was to make the industry more comfortable with the ecosystem, was to sort of give them a push to come and invest in the ecosystem. And now there is this focus that, of course, the overall corpus is going to be larger than the ISM 1 scheme, which was 76,000 crores. However, the incentive could be slightly trimmed. However, that said, there are going to be additional features, and there is an intention by the government that we need to move from a fab-first mindset to a mindset wherein we give a push to the overall ecosystem play. So there is going to be a push that will be given to gases, chemicals, materials, modules, designs, R&D, etc. And of course, incentives will be provided for all nodes, mature and advanced as well. With regards to delays in ISM 2.0's approval, government sources tell ET now that this is because the clearance process has become stricter. Of course, consultation has also taken a bit of time for this scheme to sort of, see the light of the day. But overall, India's semiconductor missions are at an inflection point right now. In fact, Union IT Minister Ashwini Vaishnav stated earlier in Jan that India aims to become the top 4 semiconductor manufacturing nations by 2032. And as of now, there are 4 projects which are in different phases of pilot and trial phases, which are likely to announce their commercial chip production in this year.
Okay, thank you so much for that, Sumita. Joined by Rajesh Palve as well, Head Technical and Derivative Research at Axis Securities. Rajesh, how are you viewing markets at this point?
Good afternoon, Harsh. So markets are volatile in terms of nature, but stock-specific action is playing out in market. So I think some of the pocket like banking, financials are doing good. So I think, and some of the automobile stocks are also showing sign of buying interest. But if we analyze on the Nifty front, Nifty is still struggling to cross 25,400. That's the major supply zone based on the call concentration area. So looking at the near-term, short-term structure, 25,400, once we able to take out, then we could see some short covering action to play in market. But as we are now closing to this budget event, so I think market may remain in volatility for next couple of days. On the downside, 25,250 is the key level to watch for. If it breaks below, then we could see more profit taking in Nifty. But Bank Nifty is showing sign of strength. So I think here one can deploy some long trade till Bank Nifty is holding above 59,200. I think here there is an opportunity for further more upside towards 60,300 to 60,400. So Bank Nifty is looking more promising compared to Nifty.
Okay, so that's the take on the index. Rajesh, talk to us about some stocks that are seeing some massive profit taking today, the likes of Hindustan Zinc, Vedanta, Nalco, Hindustan Copper. In fact, these 4 names are the top Nifty 500 losers today, with cuts anywhere between 9 and 12%. Good time to buy the rally that we've seen in some of these names, because there's been a significant dip today?
No, I think one should wait as a whole commodity linked stocks are, showing sign of profit booking, as gold, silver and other commodities are also witnessing the same kind of, profit taking, as we have already seen a very strong rally in last couple of weeks for all these stocks as well as for the commodity basket. So we advise here to wait and watch, as still there is no, buying interest or any kind of reversal after this sell off. So I think we may see some more, profit taking to initiate in this counter. Hindustan Zinc now in this corrective mode, broken its 20-day moving average also. And looking at the near-term structure, I think stock may correct further towards 600 level also. So one should wait for commodity basket, be it ferrous or non-ferrous, both space are attracting supply pressure. So let this supply pressure to settle down at certain level, then one should try to buy the stocks. At this moment, I'll say keep away, don't buy this falling stocks.
Okay, Ajanta Pharma came out with numbers. Let me quickly cover some of those numbers because stocks are buzzing. You're seeing top line at 1375 odd crore versus the 1300 crore number which was estimated. Also, in terms of the kind of EBITDA number, it came in at 385 crore versus the 350 crore number that was penciled in. And thereafter, what we've seen is again profit surge versus what expectations were. So we've seen a decent kind of a move with regard to Ajanta Pharma on the back of the numbers. So that's of course one. The other one is Motherson Sumi also has come out with numbers. So that's the other piece that we'll be tracking and quickly monitoring. Your picks for this afternoon, Rajesh?
I think Bajaj Auto is looking attractive from the automobile space. The way stock managed to view breakout of last 4-5 trading session consolidation range. I think here we could see good traction towards 9700, 9750 kind of level. So one can buy Bajaj Auto with stop loss of 95.30. And another stock where we are focusing is from the banking space, that is SBI. Stock is now moving in upsloping channel on a weekly and monthly chart, and the way stock has shown outperformance compared to all other peer banking stocks. Here we could see furthermore upward momentum towards 1120 to 1130 kind of target on a trading point of view. So one can buy this stock with stop loss of 1045.
Okay, so that's the take coming in on what the outlook is in some stocks that are looking good to Rajesh right now. We've spoken about some of the big losers, but on the flip side, Kunal, today some defense names are doing very well for themselves. Garden Reach is up 7.5%. You have some other stocks from the defense group that are doing well. What's your take on some of the shipbuilding names in particular? Because we've seen some swings over there in the recent past.
See, I think if I exclude the budget even and I assume that it doesn't hamper the trend for the defense stocks, it's a very good trend in the making for these defense names, because the Nifty India Defense, for example, as a chart, I think is heading towards a classical breakout. There are indicator turns which have happened for the index on the weekly basis. You're looking at many of the stocks like BEL taking charge as leader for the entire pack. Very good recovery from Garden Reach, Mascot Dock. When you look at this, MTAR Tech. So there are many other defense names which have done very well for themselves in the last few days or maybe 1.5 week of this market recovery. So that I believe could be a context that you might expect that the markets are expecting something on the positive side going to the defense, going to the budget for the defense counters. This should augur very well, because what happens is if you see a synchronized move across various stocks within a sector, that's a classical sign of a trend in the making. And we've seen historically that when trends are in the making, for example, what happened to Bank Nifty or Metal Index as such, there are very strong possibilities that those trends may last for not just few days, but potentially even for a few months. So that I believe could be a case in point. And that's why even after yesterday's correction for, I think, a 3% or a 5% correction for BEL, the stock has managed to absorb that quite well for itself and trying to make a comeback for itself.
Okay, so that's on some of the defense counters, but let's just focus and get into an interaction with one of the corporate voices. Greenlam Industries, on the back of their earnings, let's pull up the stock and see what the stock is doing. If I take a look at the numbers, the revenue is up 17.5%, but margins have seen a little bit of a pressure, and this time around they've logged in a very minute net loss compared to a profit of about 12.5 crores this time last year. So that's on Greenlam Industries. Let's understand how the quarter has shaped up to be and what's the outlook more importantly. We have Mr. Ashok Sharma, the CFO at Greenlam Industries, joining us on the show. Mr. Sharma, good afternoon and welcome to the show. Let's start by talking about your quarter three. Your top line grew by 17% on a year-on-year basis in quarter three, which is in line with your guidance. If you could help us understand what are the growth drivers behind this, and you still maintain that guidance of 18 to 20% for FY26, and if so, what's the outlook for FY27?
We maintain this same outlook. We are hopeful that quarter one we will be able to, whatever the difference, we will be able to make good in the quarter four. And for the next year, our guidance will be in line with seeing the current market scenario is like 15 to 18%.
Your margins saw some pressure in quarter three, like we were talking about. What is the key reason behind this? What's the margin outlook going forward? Margins have come in at 9.7% compared to 10.6%, so it's about a 90 bips cut on a year-on-year basis.
Yeah. So if you see in the margin, if you dissect it, laminate margin is steady state. There is a little bit down due to the sales in comparison to last quarter is lower. Otherwise, the laminate margin is intact. The the other vertical, since the margin were in negative, and those margin like particle board or chipboard is as of now is growing, and we are very hopeful that in quarter two we get a better result in comparison to previous quarter, so to say the next year. So we are hopeful with this we will be able to, our margin will be better than this year.
Okay, and since you've spoken about segments, I want to understand a little bit more about the chipboard business. What is the revenue and margin outlook over there?
So if you see in the last quarter, in the quarter three, we did around 54 crores. So with this, we have come nearly around 130, 135 crore in 9 months. And we are hopeful that this year we should be very close to around 200 odd crore. And next year this will go up from here. So which means we will be close to around 35-40% of the utilization. Next year we are targeting around 55-60% utilization.
All right, and Mr. Sharma, how much capex have you already utilized in the 9 months gone by of this financial year? And if you could throw some color on what is going to be your capex outlook going forward?
So on the capex front, this year major capex was, or the pending capex which was there for the previous year, which we are completing in this year. So around 80-85 crore of capex has been done till 9 months, and remaining will be done in the quarter four. For the next year, we have already announced one laminate brownfield expansion at our South India plant. So that's around 70 crore. Apart from that, there will be a routine capex. So we believe that the capex for next year should be in the range of 100 to 125 crore.
Okay, Mr. Sharma, help me understand in terms of what the contribution from exports is at present, and what is the growth that you're expecting from the export segment, and basically what's the outlook here?
So export, we do primarily export laminate. We are largest exporter of laminate from India since past 16 years. And apart from the laminate, there is very little export happens in other category. So in laminate, the export portion is slightly above 50%. Overall, it is like it hovers from 40 to 45% in between. And which even though export also will grow, but since we are exporting only laminate, so export as a percentage will remain around 40-42% of the overall business. And we expect the export also to grow in line with the company's overall growth target for laminates.
Okay, so 42% of your business, you're expecting that to come in from exports. So that sounds optimistic. Lastly, also talk to us about where the volume number is right now, and going ahead, what would be a realistic volume number to expect?
Volume growth, if we see in quarter three, the laminate was almost at the similar level in the previous what it was there. So there was no volume growth in laminate. There was slight volume growth in domestic, but in export there was slight degrowth. In the our other businesses, if I say plywood was having a volume growth of around 12%. Decorative veneer was 10%, and the chipboard, since it was started in the quarter four of this year, so there was on a year there was not comparable figure, but on a quarter there was a volume growth. So we expect that volume growth in line with our expectation for the next year. We expect around 6-7% volume growth in laminate. And in terms of chipboard, wherein we are ramping up our production, there will be a volume growth in comparison to this year.
Okay, Mr. Sharma, with that, we'll let you go. Thank you so much for sharing your growth outlook with us. That was the management of Greenlam Industries joining us on the show. But shifting focus and onto an ET Now exclusive, sources say that the government could announce a package for urban infra push. Prakash is joining us with all of those details. Prakash, what are you picking up ahead of the budget?
Well, we can see some significant announcements regarding urban infrastructure in the budget. Sources suggest that the government is likely to provide impetus to quality urban infrastructure. In fact, key announcements are expected to improve quality infrastructure. In fact, a dedicated financial package is likely to be announced that could be provided to urban local bodies to improve quality of life in urban areas. A very significant development coming in. In fact, we saw some significant announcements related to quality urbanization in the economic survey as well, which was presented yesterday. In fact, there was a dedicated chapter on quality urbanization. In fact, the survey has made several recommendations on the need for a strong urban infrastructure. In fact, it has laid out a roadmap for India's future cities, which is well designed and could provide a quality life. A very significant development coming in, and these efforts are being made to provide a quality life in urban areas by making urban local bodies financially viable. Sources also suggest that the financial support will be provided to urban local bodies on the basis of improved governance and robust revenue model. Back to you.
Okay, Prakash, thanks for taking us through that. So yes, that is yet another development that we could see in the budget, and just we're counting down to the budget now, literally in hours. So much to watch out for, and we're going to be bringing you a lot of exclusive information as and when we get that in terms of what we can expect as we head closer to the budget. But Rajesh, let's talk about some areas where the budget could focus, and one of them is going to be defense for sure. We've spoken about that, but what about consumption? We've seen GST come into play. Do you believe that some staple names or maybe consumer durable stocks could stand to gain? And if so, if at all you're liking anything from this basket, what would those names be?
I think it's still, if we look at the consumption basket, most of the stocks are in consolidation itself. There is no as such sign of major accumulation or any buyings in this space. But if we analyze on the little, short to medium term perspective, most of the stocks are holding their previous swing low. So I think some of the stocks from FMCG basket like Hindustan Unilever, it's almost trading near to its important support area of 2350. So if it continues to hold above this level, some pullback we may see towards 2400 to 2450 kind of zone. So one can focus on this stock. From the same basket, I think one can look at another stock like Dabur. It's again in the consolidation. So 490 is the crucial level for this consolidation. If it continues to hold, I think here also we could see some pullback action. But as such, most of the stocks are showing a muted kind of behavior. There is no as such accumulation or some pre-budget buying action has been there in the screen.
Okay. Kunal, let me come to you with regard to some of the EMS counters. They're doing very, very well in trade today. Anything changes with regard to your position of some of these counters on charts? A Dixon Tech, a Sirma doing very well.
Yeah, I think Sirma has been something which has been doing very well for itself relatively. I think that stock has shown very good strength over the last 6 months or so. So it's a good sign that the stock is trying to carry forward the momentum after a brief period of correction. Dixon Tech, I think after that 40%, 50% plus kind of a correction, I'll not call it as a 3% bounce for the stock or a couple of percentage points on the stock price as a trend changing. The stock has to do a lot more to try and give that confidence that it's looking at a major trend reversal of sorts. So I would probably look at this as more of a results based reaction for the stock price. Maybe once that settles into, you might probably expect the stock to go back to another round of a selling spree.
Oh, so that stock has actually cooled off from the highs of the day. So yes, at least a 2 to 3% downtake on that counter. Rajesh, in terms of sectors, and one sector which is standing out today is the Nifty Metal Index. What next for this one? We've seen a stupendous rally. Is this just a bit of a pullback before we resume, or is there a risk that we may actually break down with regard to metals and specific counters?
No, I think Harsh, one should wait for let this supply pressure to settle down. How this supply pressure further extend further or not, that we need to wait for another couple of days. Once this supply pressure settle down, then we will analyze on the stocks front which stocks are able to hold the near term, short term support areas. Most of the stocks in this today's sell off has broken their near term support area. So I think. Another couple of days will give more clarity on this metal space.
Kunal, last trading day for the month of January, I'm just looking at how the indexes have done, and it's real estate that's lower by about 11% in just a month gone by. Godrej Properties is lower by 21%, Signature Global 20%, Brigade 15%. Yes, we've seen these moves, but if you put it together, the number is quite large. Any buying opportunity here or wait and watch?
And these are solid companies
They
as such,
are.
So I think in that context, yes. In fact, a couple of days back, we had highlighted DLF as one of the contra picks, from the real estate pack, because the risk reward was mouth-watering for the stock price, trading at almost at 600 mark, 605 levels for DLF at that point of time, a divergence of more than 15-16% from its 200-day moving average. Godrej Properties, I think, for example, has a divergence of more than 30-35% from its long-term moving averages. These are steep aberrations for stock prices when they fall in such a sharp manner, and you are bound to play for a bounce back. So that bounce has already come for the real estate stocks in the last 2-3 days. I think DLF has moved up 5-6% from those lows of 600 or sub 600 levels. I'll wait for the budget event to pass out and then probably try and take a contra bet yet again. But yeah, I think the more these stocks keep on falling on a sharper basis, if in case that happens, the risk reward starts to open up quite positively for a contra buy.
Okay, with that, Rajesh, Kunal, thanks. Kunal, stay on with us. But Rajesh, thanks so much for your time today. We'll let you go. About a minute and a half left for the market. So let's start winding down for the day, for the week, and of course for the month too. Just taking a look at where the indexes are right now. It's a 0.4% shave off coming in on the Nifty today. 25,325 thereabouts is where we're at. India VIX is up 2%. Nifty Bank has seen a 0.5% cut as well. What really looks good to me right now is the advance decline ratio that still continues to be in the favor of the advances on the back of the moves that we've seen in the broader market today. Although the mid-cap index is under pressure, it's a small-cap index doing well for itself, up 0.2%, and most of the gainers on the back of earnings or otherwise have been largely from this space. From the Nifty 50 group of stocks on the back of very good set of numbers, Nestle is up about 3.25%. Tata Consumer continues to do well. Apollo Hospitals, M&M, ITC, Bajaj Auto, Titan all doing well. On the flip side, some metal stocks and oil and gas counters taking a big hit. Hindalco, Tata Steel, Coal India, ONGC, JSW Steel, these are some of the top Nifty 50 losers. Sectorally also, not much has changed since the get-go today. You have names like FMCG that are doing well, led by Radico, Nestle and United Breweries. Nifty Auto is also holding on to gains led by Uno Minda and M&M. Nifty Realty continuing to do well along with Nifty Pharma. PSU banks are absolutely flat, but the big cuts today are on Nifty Metal. A 5.5% cut on an intraday basis today. Vedanta, Hindustan Copper, Nalco, Hindalco, Tata Steel, all of them are lower. Following that is Nifty IT, big cuts over there too on names like Tech Mahindra, HCL Tech, Coforge and Wipro, all lower by about 1.5%. Just summing it up from the broader end of the market, you have OneSource Specialty Pharma, earnings candidate about 8% uptick over there. Signature Global is up 7.5%. Garden Reach, Triveni Engineering, Acme Solar, Newland Labs, Praj Industries, Blue Star, RR Cable, all of them are up 5% or more each. So good move here. And on the flip side, it's NTPC Green, MCX, Hudco, Deepak Fertilizers, Ambuja Cements and Swiggy that continue to reel under pressure. Remember, Swiggy on the back of its earnings is also lower by 4.5%. So that is how we're shutting shop for the day. Just on a monthly basis, since we're wrapping down on January 2, it's PSU banks, metals that have done well. Nifty IT nominally, Nifty Bank on the flat line with big cuts on realty, FMCG, auto and pharma. Kunal, your take on how we've closed today, last trading session, or if you could formally call it that, before the big day, the budget. How do you think the market is heading into the budget? Are you seeing any caution because we've shut shop with about a 0.5% cut today?
Statistically, it's a different market because 8 out of the last 12 budgets which we've seen under this government, there has been 62% probability that the markets have closed negative. Sorry, positive. So we've closed on the negative side, which means that maybe we're just about trying to contradict the statistics which has been there, or in that 38% kind of a zone. What's another positive is that on the budget day, the markets have historically closed on the negative side. Okay. So maybe we can see that also reversing on Sunday come Sunday, and hopefully the markets close on a positive note. There's one point. So, today what has happened is that there's been a clear selling which has happened for the Nifty Metal Index. Now, what this does is that if the markets have to balance itself, say at 25,500 levels, thereabouts, plus minus 250 points, there has to be another sector which has tried to offset the kind of moves metal index have done. So, I think this could now open up or maybe give space for other sectors to try and come back into a zone of outperformance. So, from here on, I think what one should keep an eye on is that if the metal index continues to see a selling spree, say in the next couple of days further, you have to keep an eye on other sectors which could now tend to become the next metal index move, which could last for another 1 to 3 months.
What do you reckon this sector might be?
We'll see over the next couple of days how pattern played out.
What about sensitives, budget sensitives, defense, realty? Will it be a good day to kind of nibble on in terms of those couple of sectors, couple of names? Defense has had a fabulous move this week. So,
exactly.
On the back of that move, do you still recommend?
Yeah, so I think defense at large also. I'm not saying just as a budget play, but even at large, I think we have to be a part of your core portfolio. The percentage allocation depends on the kind of risk appetite you're okay to take. But I strongly believe that defense counters and the stronger ones, BEL, HAL, you have so many of the other names which have been doing fabulous on the charts, MTARTech, etc. I think these stocks are looking quite strong on the long-term chart. So not just as a budget play, but strongly recommended as more of a positional as well as a portfolio play for the for the portfolios as a defense pack.
Okay, and we've been talking about earnings. It's been a stellar set of numbers for Ambuja Cement for the quarter gone by. The cement major reported its highest ever quarterly volumes, with profits skyrocketing by more than 250% compared to the same time last year. Meanwhile, the revenue gains 20%, supported by improvement in realization of 5 rupees per bag. The EBITDA per ton also gained over 30% to 718 rupees. But with that, we're completely timed out on this edition of Closing Trades. We are going to see you on Budget Day, and we're all very excited to see you. So catch all the action here on ET Now.